Chipotle's up more than 1% this morning. And who doesn't love it? Problem is the market hasn't just hit 52-week lows. Tom White's looking at the options. Caleb Silver joins us from Investopedia. Caleb, good morning. Thanks for being here. Chipotle, how important is this company is testing the consumer?
Yeah, this is right in the middle of everything. This is right in the middle of tariffs. This is right in the middle of consumer spending and sentiment, right in the middle of discretionary spending for consumers. Because when you think about it, a burrito bowl or a burrito there's 17, 18 bucks. There's a lot cheaper options. And I think consumers are going to be looking for those. Plus the pressure from tariffs. We got avocado tariffs probably coming tomorrow. Those are going to hit them big time. And they're still coming out of that sort of skimpy portion scandal last summer that cost them some reputational damage.
Yeah, well, you just had to know the right guy in the line. No, my trick is I just show up late. Show up late, and they're much more generous, and it'll give you the double scoops. So to the point of the connection to the consumer, I mean, it's kind of the fast casual icon, right? So it's sort of in the middle of your price point. It seems like if Chipotle then breaks down, then you've got a message that people are really pulling back in a way they haven't in a while.
Yeah, when you look at Chipotle versus some competitors, put Cava up there too.
Yeah.
That is also sort of fast casual, a little bit more on the expensive side. Those two stocks are down more than about 16, 17% each. Then you look at McDonald's, that stock's up around 7%. So I think consumers have also decided what's discretionary and what's a staple when it comes to eating out right now. Starbucks also up 7% so far this year, but also they have Chipotle's old CEO running things over there now. And it's been kind of a rough ride since Scott Boatwright took over as CEO for the company after Brian Niccol left the company last summer. He came right in the middle of the skimpy portion scandal. They had to increase portion size, and that cost them, they said, about 9 basis points. That rocked the stock. And then, of course, we've had these concerns about tariffs through the beginning of this year, and also a souring consumer sentiment. Bad recipe for Chipotle.
Good point on Starbucks outperforming next to McDonald's this year. CMG Cava, that's a nice chart. I like that, showing that underperformance. Even within that bracket of price, doesn't seem massive in magnitude, but the market has sniffed out everything in terms of relative weakness right now. Starbucks with Brian Niccol at the helm too, pretty interesting. What do you see in your analysis of the market generally, Caleb? Do you think the concerns about a massive drop off in jobs and real hard data is worthy?
I think so, and I think that has psychological damage as well. Whether or not it's real or whether it's going to happen or not, we're going to see. The data is going to play it out, but I think just the psychological damage that it's doing, people talking about a slowdown, people talking about a recession, this pullback in spending, pullback in sentiment, and that rise in the personal savings rate, that'll give you some clues as to what consumers are thinking. When we're pulling back as consumers, we're also potentially pulling back as investors. But as you know, retail investors have been trying to buy this dip now for the past 3 to 4 weeks unsuccessfully, which is painful to watch when you watch global fund managers running one way and retail investors running in. Not a great mix, especially when these sell-offs are so violent.
Yeah, fair. Like that point, and I think also the difference in the price point of the food category is an astute observation. Good knowledge on the company. Thanks, Caleb. Appreciate that.
Thank you.
Tom, let's trade it.
Yeah.
What do you think? The relative performance, by the way, Cava and Chipotle dropping off next to Starbucks and McDonald's. I really like that from Caleb.
Yeah, and you take a look at it. McDonald's just off all-time highs that it hit earlier in March. Yum Brands hit all-time highs, and now you're starting to see this underperformance in Chipotle, and maybe it's about scale at this point, and price point and inflation. So I looked at something. They've got earnings coming up on the 23rd of April. So maybe the underperformance, if you think it's going to overperform or at least be a catalyst to the upside for earnings, I looked at a strategy that takes advantage of that, where I'm just going to buy something in the money. There's not a lot of extrinsic option premium in a lot of these strikes. So I looked at a stock replacement type strategy where I'm going to go in the money out in that April 25th weekly cycle. We're going to capture earnings, and I'm going to buy the 48 strike call. It's got a delta of nearly 70, so it reacts more like the stock. And you don't have to buy the shares. It doesn't pay a dividend, so you don't have to worry about a covered call or owning the shares on this. But if you think the stock's going to rally into that earnings and after that earnings, this takes advantage of it. If you pay roughly a debit of about $3.90, you'll probably have to pay a little bit more. The stock has moved a little bit higher here in the early stages of the trading day. So if you pay that $3.90 debit, you add it to the 48 strike that you're buying in there, $51.90. is going to be your break even. That's less than 2% above the current share price in Chipotle. So you don't need a monster move. The option market for that option series pricing over a plus or minus nearly $6 move either way. So you could easily get that pop. But you know what your risk is? The risk is a debit you pay on this one. Anything to the upside, about 1.5% from current share price. Going to be profitability on the Chipotle trade.
Okay. All right. Chipotle, a little bit riskier, I guess, at this point, given the chart. But that's why you got to trade in Mickey D's.
Yeah.
A little bit more reliable. Mickey D's and Starbucks,
up
on top of each other.
Yeah,
on
up
the year.
8% this year. Maybe that's it. Everybody's trading down, going to McDonald's. It's the cheapest, right? They extend that $5 meal deal. Or
Starbucks. Hey,
Yeah.
I can hit the Starbucks breakfast sandwich, and that could be a lunch for me. That could take me a good 5 hours. That could block off a big amount of time for my stomach.
That's probably good, right? Probably cheaper that way, too.
So I'm saying it's like
Yeah.
$6. The sausage, egg, and cheese is a power punch.
Now, they report earnings on the 1st of May, so you got to take that into consideration. I'm looking at a strategy that avoids that one because the stock has outperformed the overall market. I think a lot of people are using this one as a safety play also. Pays a decent dividend of over 2.25%. So I looked at something a little bit more conservative, but still risk-defying. Going out to that April 25th weekly cycle, so 24 days to expiration. We're just going to sell a near the money short put vertical, sell the 310 put, buy the 300 strike put, short $10 wide, neutral to bullish put vertical, collecting roughly about 250 credit. That's what you can make on it, $750 at risk. But it takes your break even down to 307.50 to the downside. That's about 1.5% below the current share price in there. So conservative, but at the same time, if you think that this thing is going to stabilize, be held up because it's a safety play, or that you think it's going to rally into earnings, this will take advantage of it. Still staying risk defined. You just want it to kind of remain here or grind higher.
Got it. All right. Like it. So both bullish, different forms, right? Selling downside in Chipotle.
In McDonald's.
McDonald's.
Yeah, buying the deep in the money call in
Deep
CMG.
in the money call. That's what I was thinking for CMG.
Yeah.
Okay. So risk on for CMG. Risk on for both.
Yep.
All right. McDonald's, 30 bips. Not bad. Could be worse. Thanks, Tom.